on this opening net liability, you have to recognize a net in Brassic company question 5 of the B company executive director. Hi students, how are you? I'm your tutor Abu Bakr Sadiq, and I'm your tutor for strategic business reporting. Today we are going to discuss a question from the past paper of March-June 2024. And in this session, the question which we are going to discuss is a question number one of March-June 24. And as you know, that the first question of every SBR exam is relating to group accounts, group accounts. And the question which we are going to discuss is Brassic company question. And the background of the question, if we discuss, there is a company with the name of Layout. That is a manufacturing company, and it has a financial year end of 31st December X7. And the exhibit which would be relevant for this question is number one, exhibit relating to Brassic company. That exhibit provide information about the ownership and representation in the board of directors. Then we have some accounting issues relating to pension plan of a Layout company. That is issue of IAS 19 employee benefit. Then we have acquisition of Brassic company, set out details regarding the acquisition of Brassic company. Then we have a draft consolidated statement of financial position of the group, a pre-populated spreadsheet. Obviously, at the end, we have to incorporate the adjustment, and we have to rectify that statement of financial position. So that is the background of the question. So let's start it. And the first exhibit, that is a Brassic company, and the requirement of that exhibit is that is using exhibit 1 and accordance with the IFRS 10 consolidated financial statement, explain that why Layout company does not control the B company, does not control the Brassic company. That is the requirement number one, and that is relating to the first exhibit. Now let's read the first exhibit, and that exhibit is that the background of that exhibit is, or the detail. Okay. So on 1st January X7, Layout company acquired 45% of the equity share capital of the B company, a private company. On acquisition date, the 45% of the equity capital, Layout company could appoint 5 of the B company executive directors and 4 of the B company non-executive directors. There are 12 executive directors and 7 non-executive directors, which comprise B company's board of directors. The executive director make all key business decisions by simple majority, and the non-executive director help in strategic development of a company and provide advice to the executive director but cannot vote on business decisions. The directors appointed by the layout company always vote in a line with the layout company policy. The other 55% shares are owned by the single private investor who can appoint the remaining 7 executive directors and the 3 non-executive directors. So the remaining 55%, 45% owned by the layout company, and the remaining 55% is owned by a single investor who will appoint the remaining 7 directors and 3 non-executive directors. 7 direct executive and 3 non-executive. Now, during the year ended December X7, layout company entered into a forward contract to purchase additional 10% of the equity capital of the B company in October X8. When exercised, this will not change the number of directors which the layout company can appoint. So even if that is exercised, after that, even you cannot appoint more than 5 directors of executive directors. That would not going to change. Layout company believed that it controlled the B company and has accounted for B company as a subsidiary in the consolidated financial statement for the year ended 31st December X7. So this is the total story. And the requirement is that, if you read that requirement again, that using Exhibit 1, in accordance with IFRS 1, explain why layout company does not control the B company. The B company, layout company does not control the B company. Now, first of all, if we discuss the definition of the control or the meaning of the control, the meaning of the control is that you have a power to take financial and operational decisions of the subsidiary. You have a power. You have a power to take decisions. And normally that power comes when you have more than 50% shareholding. If you have more than 50% shareholding in a company, then it is presumed that you have that power and you have the ability to use that power to take the financial and operational decision of a company. And you take the decision and you can, and due to that power and due to that decision making, you can affect the returns of the investing company if you have a power. And further, IFRS 10, or according to IFRS 10, the parent company or the company has a power or has a control over the subsidiary if it has a power over the investing, and they have exposure or a right to variable return from involvement with the investing company. Exposure or right to a variable return. Variable return. And for variable return means you have the equity interest in that company. That simply means. Then the third one is that you have the ability to use that power. You have an ability to use that power to affect the decision making of the subsidiary company, and you can affect the returns of your investee company. So you should have a power, you should have exposure or right to variable return, and you should have ability to use that power as well. And normally these 3 things, as I discussed earlier, you have if you have more than 50% shareholding. But in that case, you does not have 50% or more than 50%. Here you have 45% shareholding. Now, 45% is a major shareholding, but the problem is that the other 55% is not spread among the number of investors. Other 55% is held by only one investor. Only one investor. Only one investor. So other 55% is with only one investor. And further, one more thing. You have the right to appoint 5 executive directors out of total 12 executive directors. And the decision making is done by the executive director. Now, it doesn't matter that how many you have non-executive director in that company, because non-executive director does not take the decision. They does not have a power to take decision. Their role is just is regarding the supervisory role. They have nothing to do with the decision making. These are the executive directors who take the decision. And in that company, there are 12 executive directors, and you have a right to appoint only 5 executive directors out of 12. And the remaining 7 will be appointed by the other investor who hold the remaining 55%. And whenever there will be a decision making, the decision will be made with the 7 directors, and you have just 5, and the other 7 are with the other investors. So it means you does not have a control at the moment. You does not have a control. You does not have more than 50% shareholding right. You have not majority of executive directors in the board of directors. So you does not have the ability to use that power. You does not have the power, or neither you have the ability to use that power to take the decision. Yes, there is one point to be further consider is that you have a forward contract, and according to that forward contract, you can acquire another 10% shareholding in that company. But however, at the year end, 31st December X7, you have just 45%. The increase in 10% shareholding, if you acquire the further 10%, that means we're talking about the future. But at the year end, 31st December X7, you have just 45% shareholding. That 10%, if you acquire, that is basically the issue of the future. That is a future factor. But at the year end, you have 45%. And at this year end, you do not have a control over that subsidiary. Okay. So the conclusion would be that after discussing all these factors, the conclusion would be that the the layout company does not have a control over the Brassico company. They does not have a control over a B company. So it should not be treated as a subsidiary. It should not be treated as a subsidiary. If they are treating it as a subsidiary, they are doing a wrong accounting. They are doing a wrong accounting. It's not their subsidiary company. So that is the issue relating to the first requirement and first exhibit, in which we just need to discuss that why the layout company does not have a control over the B company as per the definition of IFRS 10. Okay, so that was the first question, and it not this type of question is normally tested in nowadays in SBR. They are very interested. Take very interest. The examiner take interest to check this aspect, that candidate can identify that the parent company has a control or not, or the students or the candidate does understand the meaning of the control. So that's why such questions, such requirements are frequently tested in SBR exam. Now, after that, completing exhibit 1 and discussion of exhibit 1, the second exhibit is about the pension plan. Is about the pension plan. Let's first of all read the requirement. And that requirement is using the exhibit 2 with appropriate calculation. How defined benefit plan should be accounted for at the year ended 31st December 20X7. And here you have the exhibit. Now, at 1st January X7, the defined benefit pension plan of the layout company had a net deficit of 24 million. The actuary has provided the following information for the year ended 31st December X7. Current service cost, cash contribution into a plan on December X7, and the net deficit at December X7, which is 32. On 1st January X7, interest on a high quality corporate bond is 5%. On 31st December X7, the pension plan extinguished its obligation to 250 ex-employees by paying 60 million out of its plan asset to another pension provider, and this reduced the present value of the obligation by 50 million. The value of the asset decreased by 60 and the value of the obligation decreased by 50 due to this settlement of the plan. After the above event, the actuary valued the deficit at $40 million at December X7. The only accounting entry in this respect of the pension was to recognize the cash contribution as an expense in a statement of profit and loss account. Now, first of all, this is an issue of IAS 19 employee benefit. And in employee benefit, it is a defined benefit pension plan, defined benefit pension plan. And in defined benefit pension plan, you have defined the benefit of the employee. So you have to recognize a net liability or a net asset. Net liability is recognized when the present value of the pension obligation is more than the fair value of the plan asset. That means your plan is in deficit. And normally these plans are in deficit. If they are, if we have the value of the plan asset more than the obligation, then that means you have a surplus. And if you have a surplus, then you have a right to reduce the future contribution, or you can withdraw the amount from the funds, keeping in mind the asset ceiling. But here in this case, we have the deficit, and the opening value of the deficit or a net liability on 1st January X7 is $24 million US. Now, in a defined benefit plan, you need to recognize a net interest, which will be recognized in profit and loss account. Current service cost is recognized in profit and loss account. And the cash contribution into the plan by the employee basically increase the value of the plan asset or decrease the net liability. When there will be increase in plan asset, obviously the net liability would decrease. Now here the mistake done by the accountant is that they have recognized this contribution as an expense. They have debit the expense. They have debit the expense in profit and loss account with the contribution, which the employer has done in a plan asset. They have recorded it as an expense rather than as a reduction in a net liability. Here they are on mistake. So that thing we need to adjust first of all. And the net interest which we record as per IAS 19 should be recorded using the high quality corporate bond, which is 5%. So the net interest which we will recognize will be 24 into 5%. 24 into 5%, and that will be, I think, $12. 24 into 5%. The answer will be $12. And that $12 you need to recognize as a net interest expense in profit and loss account. 24 million, okay, 24 million, and into 10%, that would be 1.2 million. Yeah, that would be 1.2 million, not 12 million. 1.2 million is the net interest expense, which should be recognized in profit and loss account. Along with that, the current service cost of 6 million should be recognized as a profit and loss account. And further, the 4 million which they have recorded as an expense, that should be reversed. Expense should be credited, and their it should be treated as a reduction in liability, as a reduction in liability. Further, there is an settlement in which you have transfer a fund of 60 million to the ex-employee, to another pension fund. But the value of the liability is reduced by just $50 million. So the value of the asset, plan asset, is decreased by 60, and value of the obligation decreased by 50. So you have a loss of 10 million US dollar on this settlement. Now, this loss on settlement is also recorded as a expense in profit and loss account. Now, the current service cost, loss on settlement, or there is another thing which is past service cost, they are known as service components. And service components are recognized in profit and loss account. Profit and loss account. Now, if I do the proper recording now, so you have an opening value of liability. You have an opening value of liability, which is 24 million US dollar. It's a opening net liability. On this opening net liability, you have to recognize a net interest expense of 1.2 million. It will be recorded as a debit balance in a profit and loss account, mean it will be recorded as an expense. Then you have a current service cost of a 6 million. It should be recognized in a profit and loss account. It will be a debit in a profit and loss expense. Then there is a settlement. And in settlement, you have a loss of 10 million. Value of the asset decreased by 60. And the value of obligation decreased by 50. So you have a 10 loss. And this loss will also recorded in profit and loss account as an expense. It will debit the profit and loss account. And there is a contribution by the employer. Now, normally when employer contribute the fund, the net liability should be reduced and bank should be credited with 4 million. That is the right entry. But accountant recorded it incorrectly, and accountant debited the profit and loss account and credit the bank by 4 million. Now, to rectify this, you have to debit the net liability and you have to credit the profit and loss account by 4 million. That would be the rectification. That would be the rectification. And the impact of that rectification will be, due to contribution, value of the obligation would be decreased by 4 million. And your closing liability will be a 40 million US dollar, not 32, 40, because in 40 they have considered the settlement. In 32 million they didn't consider the settlement, so it is irrelevant that the liability is 32. Actual liability according to actuary is 40, in which they have considered the settlement. Now, after doing all this, you will get a remeasurement gain or remeasurement loss, remeasurement gain or remeasurement loss, and that will be the balancing figure. And if you calculate the balancing figure here, and that balancing figure would be 2.8 million. And this 2.8 million is basically a remeasurement loss. And it will be recognized in other comprehensive income. So you will show this calculation and you will discuss the treatment. Of the defined benefit plan. All the things which I have did here, you need to discuss there in exam, and you have to elaborate it. And if we make the extracts are not required, but if we make the extract, that would be like that. Net interest of 1.2 million will be recorded in profit and loss account. Current service cost of 6 million will be recorded in profit and loss account. The loss on settlement of 10 will be recorded in profit and loss account. And the contribution, which they have previously recorded as an expense, it will be reversed in a profit and loss account. Profit and loss account will be credited. And then other comprehensive income. In other comprehensive income, you will show the remeasurement loss of 2.8 million. And finally, in a statement of financial position, in a non-current liability, you will present the pension liability at 40 million US dollars. So that would be the whole story of the defined benefit plan in this question. Okay. So that was the IAS 19. And if you focus, you will learn one thing, that if you have a good understanding of the accounting standards, then you can attempt the question very smoothly. If you are looking at this requirement relating to IAS 19, it is simply the application of defined benefit scheme. And if you know the treatment of the pension benefit plan, defined benefit plan under post-employment benefit of IAS 19, it would not be an issue to answer such type of question. You just need to get the good understanding of the standards which are examinable in strategic business reporting in SBR exam. So that was the issue of the pension plan. Now continue with the practice. We will first of all look at the next requirement. And the next requirement is of 14 marks. And in this requirement, using Exhibit 2.3, adjust the pre-populated spreadsheet response option to correct the draft statement of financial position as at 31st December 2007. Using Exhibit 2 and Exhibit 3. B company is an associate, not a subsidiary of the layout, and the defined benefit pension plan has not been correctly accounted for. So this is the draft statement of financial position, in which they have recorded the defined benefit plan wrongly. They have consolidated the B company as a subsidiary, which is not their subsidiary. It should be accounted for using the equity method in IAS 28. Now, but before that, read the exhibit number 3. Now look at the exhibit number 3. Then we will move towards the last area. On 1st January, X7, layout acquired 45% of the 10 million equity of the B company. This gave layout significant influence over a B company. However, the investment was wrongly classified as a subsidiary and accounted for using the acquisition method in a consolidated financial statement. When calculating on 1st January goodwill on 1st January X7, the NCI was made at fair value of 51, and the fair value of the identifiable net asset were 83, and the purchase consideration of a cash was 35. On 1st January X7, retained earnings were 39, other component of equity were 3, and the difference between the fair value of the net asset and the carrying amount in an individual financial statement was attributable to the property, plant, and equipment with the remaining life of 5 years at acquisition date. Now, the individual financial position of the B company as at 31st December X7 is as follows. Individual. In which they have the following: property, plant and equipment, current assets, share capital, other component of equity, retained earnings, liabilities, current liabilities, and total equity and liability. Now, keeping in mind, now we need to rectify the given spreadsheet. The given spreadsheet. That is, this is a draft balance sheet. In this draft balance sheet, we need to place the adjustments, and the first category will be the adjustment relating to subsidiary of the Brassico Limited. As a subsidiary, we need to eliminate the subsidiary from the financial position, and we need to account for the associate company. This is the adjustment. Then we have adjustment relating to the pension plan, in which we need to account for pension net interest, pension current service cost, settlement, contribution, and remeasurement, gain and loss. Let me adjust the cell. And finally, you will be having the adjusted statement of financial position. Now, starting from the exhibit number 2, that is the pension. The first thing you need to consider is that they have wrongly treated the contribution. They have recorded the contribution as an expense. And now when we are saying that they have recorded the contribution as an expense, then that means they have recorded that impact in a retained earning. And you have the retained earning here in a draft financial position in, look at here, 21. And you have a contribution H21. So here, H21. You will add the 4. 4 will be added here. 4 will be added here. 4 will be added here. Because when we will adjust it, we will reverse the expense which we have recorded in profit and loss account, and obviously it has impacted the retained earning. And we need to adjust that value in the pension liability. Now, the opening value of the pension liability is 24, and this 4 million should be recorded as a reduction in liability. Okay, so liability is debited and retained earning is credited. Liability is debited and retained earning is credited. The other thing which we need to adjust here is the net interest, current service cost, and the settlement. Now come here again The retained earnings are in 21, 21. So we have a net interest of 24 into 5%, which is 1.2. When it will be recorded, retained earning will be debited. Retained earning would be debited, and the obligation will be credited with 1.2 million, with 1.2 million, with 1.2 million. And net interest debited means the retained earning will be debited. Then we have a current service cost in the next area. And when we record the current service cost, again, the retained earning will be decreased by $6, and the value of the obligation will increase by $6. Then we have a loss of 10 million. And when we will record the value loss of 10 million, basically it would be increasing. It will be increasing the value of liability by the 10 million. Because value of the asset is decreased by 60 and value of the obligation is decreased by 50. So in a net basis, basically the net liability increased by $10. So that was the accounting for net interest and service component. Now we have the remeasurement gain and remeasurement losses. And we have a remeasurement loss, and that remeasurement loss is 2.8 million. Now that would be recorded in other comprehensive income, means the other component of equity. So other component of equity will be decreased by 2.8, but the value of liability will increase by 2.8 million. 2.8 million. These are all the figures relating to exhibit number 2 I am incorporating. Net interest, current service cost, settlement loss, contribution adjustment, and the remeasurement loss, which would be recorded in other comprehensive income, and liability is increasing. So 2.8 I have recorded in other component of equity, not in retained earning. Because in retained earning, we only record those items which affect the profit and loss account. And the remeasurement loss affecting the OCI, so that's why it will be adjusted in other component of equity. Now, that was all the issues relating to the pension plan. Now we have to adjust the balance sheet with the impact of the subsidiary which we have consolidated. And here we have the information. First of all, let's eliminate the goodwill. Let's eliminate the goodwill. And for goodwill, you need to do a little bit calculation working. So this is a working one. And that working one is relating to, let's say, goodwill. Now, in goodwill, you need, first of all, investment. And investment, you have 35. Then you need to consider the fair value of NCI. And if you remember, the fair value of the NCI was, I think, that was 51. 51. If you can look at here. Yes, 51. And fair value of the net asset was 83. Fair value of the net asset was 83. So the total is equal sum 35 plus 51, 86, and less the fair value of net asset at 1st January 20x7, and that is 83. So the goodwill at the date of acquisition is basically 3. 3 is the value of the goodwill. And that value of the goodwill is recorded here in the consolidated statement of financial position, and that need to be eliminated. So goodwill need to be eliminated because this is not our substitute. So that value of the goodwill will be eliminated here. Okay. And we will record the associate cost of investment of 35, because when we prepare the consolidated financial statement, we eliminate the investment. But in associate, we record the investment at equity method. So I am recording the 35. I am recording the 35. That is the investment in associate. The another thing which we need to adjust is the property, plant, and equipment. Property, plant, and equipment. Now, for that purpose, we need to do another working, that is a working number 2, and it is relating to property, plant, and equipment. Now, there is a fair value adjustment. There is a fair value adjustment which has been carried out at the date of acquisition relating to property, plant, and equipment. Now, at the date of acquisition, fair value of the net asset was 83. That is given in a question. If you deduct from this information of 83, the carrying value of the retained earning at the date of acquisition, other component of equity, 39.3, and 10 share capital. So 39 is the retained earning, 3 is the other component of equity at the date of acquisition, and share capital was 10 million. So 31 million is the fair value adjustment at the date of acquisition, which is carried out. And obviously that adjustment has been incorporated in the consolidated financial position. And the depreciation which we have recorded on this fair value adjustment would be equals to 31 divided by the remaining useful life, and the remaining useful life was 5 years. That was 5 years. Yes, 5 years. At the date of acquisition, that was 5 years. And in the individual financial statement, carrying value is 32 million. Property, plant, and equipment in SOFP is 32. So the value which need to be adjusted in a consolidated financial statement is equal to 56.8 million. Is 56.8 million is the fair value, and that is the total value of the property, plant, and equipment relating to subsidiary company, which has been included in the above consolidated financial statement. And that 56.8 million will be eliminated. So minus 56.8 million, that need to be eliminated. Goodwill has been eliminated, property, plant, and equipment has been eliminated, 35 investment in associate has been recognized. Current assets Now look at the current assets in the balance sheet. The current assets are 47. They need to be eliminated. So minus 47. Then there is other consolidated other component of equity, consolidated retained earning, and NCI. Now we need to adjust the other component of equity if there is any other component of equity in post acquisition. In post acquisition, that need to be adjusted, but there is nothing mentioned about the other component of equity in post acquisition, so it will be 0. Yes, retained earning and NCI need to be worked out. Now, for NCI and group retained earning, how much amount need to be adjusted here? First of all, working number three is relating to the retained earning, Now, in the above financial statement, the retained earning which we have in a post acquisition would be need to work out. First of all, take the retained earning at, we are doing the working and retained earning. So first of all, retained earning at the reporting date 31st December X7. And we are talking about retained earning of the subsidiary company. Those are 55 million, are equal to 55, and these retained earnings are from individual financial statement, and there is only one adjustment relating to group account, that is a depreciation in a post acquisition period, which is 6.2 million. 6.2 million. Okay. So after adjustment, the consolidated retained earning at the reporting date are 48.8 million. Now, if you less the retained earning at acquisition date, which were basically 39, the difference will be the post acquisition. These are the post acquisition retained earning. Now, in these post acquisition retained earning, there is a share of group and there is a share of NCI. Now, what is the group share? Group share is equal to 45%, which is 4.4. Let's round it. Okay, 4.4, and the NCI share will be 5.39. So this is the working relating to the group. Let me highlight. Now 4.4. Now coming here, retained earning of 4.4 need to be eliminated, because in 1506 we have retained earning from subsidiary 4.41 million, which should not be consolidated because the B company is not our subsidiary, but they have consolidated it, so we need to eliminate. But at the same time, this B company is our associate company, so share of post reserve need to be recorded, which will be same 4.41. It would be the same, and at the same time, this 4.41 will increase the value of the associate company by 4.41. Investment is debited and retained earning would be credited. So that would be the adjustment in the group retained earning relating to the derecognition of the B company as a subsidiary and the recognition of the B company as an associate under the equity method. Now, there is another thing which need to be adjusted, and that is the NCI, working force. We need to find out that what value of NCI we have recorded. In that case, we have pre-NCI, and the value of the pre-NCI at the date of acquisition, as you know, was 51, and the post-NCI. And post-NCI we have is 5.39, carried out in a working number 3, So the total NCI value which we have incorporated in a consolidated financial position is equals to 56.39. 56.39 is the total value of the NCI which we have incorporated. And now that value of NCI again need to be adjusted. So that will be deducted from here, and that is 56.39. Now continuing that, we have net deficit liability that has been adjusted, and now we need to look at the current liability. And the current liabilities of the subsidiary were 11, and obviously that will also eliminate it from the consolidated financial position. So these are the adjustments which we need to incorporate in this pre-populated spreadsheet. Now, after doing all this, we need to calculate the values. And first of all, in number 8, equal sum then number 9, okay, equal okay, then that is the adjusted value 577.2. Then the next cell, which is relating to investment in associate, and after that goodwill, and that is the value of goodwill, and after that the total non-current assets, that will be equal sum of adjusted values of non-current assets and after that we need to total the current assets, which is 14. So equal sum and then the total assets, and the total assets will be equal to sum of adjusted non-current and current assets. So now the adjusted non-total assets are 2,154.6. There would be no change in a share capital. It will remain same, 135. Let me check the cell number, 19. $135. Other comprehensive equity will remain same, 189. Yes, the group retained earning would be changed, and that will be sum equal sum, open bracket, and other comprehensive equity will be adjusted because they were 189 and minus 2.8. Okay. So other comprehensive equity and non-controlling interest need to be adjusted in 22. So again, equal sum, and that is NCI, and then in 24, you will total the revised value of the adjusted consolidated equity. Now, after that, you will be doing the total of the net pension liability, which should be equal to 40 after incorporating all the adjustments, and yes, it is 40. And then you have a current liability in 30. So equal sum of the total current liability, that is 58, and now you have the total of equity and liability, which will be equal sum, and it should be equals to the 2154.6, and exactly they are the same. And these are the two values. So balance sheet, both sides are the same. So this was the question. And this question is relating to March, June 2024. And this is the first question of this past paper, which we have discussed today. And hopefully you people will get a good understanding that how this question should be responded in the exam, and it would be helpful. Hopefully that would be helpful for your upcoming attempt in March 2024. So thank you very much for attending this class, and we will continue to share such type of informative and understandable video lectures with you. Thank you very much, and stay tuned.